Eileen. I almost said Alan. Eileen, let's take a look at your question. I'm going to go navigate back to the main home tab. You have a 225 put on SPY expiring April 24th next week. Okay, I need to raise the put strike price. It is too low now. What is the best way to do this? Okay, I had a couple of questions over the last few weeks, some via email, and I believe one was even here during the webinar. And regardless of the cost we pay for the position, at $225 for April 24th. Let's just say we paid 60 cents for it at one point. The price is kind of, you want to say the price is relevant, okay, and it is. But again, it really isn't, and I'll explain why. So here we have a put option at 225. SPY is at 286. This is way out of the money. It's only worth 3 or 4 cents. So one of the reasons why I'm saying that the price doesn't matter is because whatever you sell this for, you're taking near the full loss on it anyway. It doesn't matter what you paid. You are going to want to factor that into your break even on the next position. But here's my response. The couple other attendees asked and via email said, what is the best way to roll my put? It's not about rolling this put. It's not about this put at all and what you're getting. It's about what is your expectation for SPY going forward for a new position. And I don't mean just a new put, Eileen. I mean a new position. This put you might be using as a market hedge for your portfolio, for your stock positions, and that's great. If you were speculating on a fall in SPY, I would have tried to close this the minute it was at, just as we talked about before, a 40 or 50% loss. So if I paid $1.10 or $1.20 for this position, and SPY started to move against me in those large jumps that we saw first, and then gradually continuing to move up, once the value of this put option reached 60 cents, where I was losing 50%, I probably would have sold to close it at that point. And now decided, what is my next step? Not trying to stay with a put to manage this position that's going against me, maybe converting it to a long call. Now, I'm not saying buy a long call on SPY. I'm saying that's what you have to decide. Taking into account the loss that you have right now on this SPY put, you say to me that you want to go to another put. What is the best way to go? What is the right move? Well, this is why we have the tool. You can get it under the long call or long put strategy or under our signature tools, and it's called the Long Option Finder. What this tool does is allow you to put in your stock symbol and your expected price. We saw SPY at 286. Now, if in the next 20 to, let's say 15 to 20 days, Eileen, I'm expecting the stock to fall, I'm expecting the market to pull back, and we might see a correction of SPY back down to 260 as more, unfortunately, we might see more poor earnings coming in, reflection of the economy and so forth. We'll have to wait and see, but we saw a big dearth of that at the beginning of the week and some warning signs. And I'm just going to put in that I'm investing $1,500 as a potential hedge or just buying one put, Eileen. And in this case, with current volatility, it's probably best to actually go up to $2,500 as some of those puts on SPY and especially SPX are expensive. And I said about 20 to 40 days from now. So let's go after standard May expiration. Okay. All right. Now, last time we did this 2 weeks ago, it did take some time to populate the results, and I apologize for that. What it's doing right now is we're downloading all of the end-of-day data for the historical options tools. That bogs down the Black-Scholes calculator and the Black-Scholes calculations that are being used right now. Usually during the trading day, before we start downloading the history, this is instantaneous. But in any case, Eileen, what is this tool doing right now? It is looking at every option on SPY, and it is calculating which option would give you the best return across all expirations, all different strike prices, if SPY hit our target of 260 on our expected date of May 22nd. Okay? So as we go along here, there we go. And what we see here is the 29th of May, 292 put, 42 days out in time. Current price of $14.70, so I could afford one contract with the cost that I put in. I had mentioned that because of volatility, these puts are pretty expensive. But if the stock was trading at 260 on May 22nd, this put option would be theoretically worth $32 or 118% return. If this was your projection of what SPY was going to do next, it doesn't matter what you're getting for the put that you have to close. That 225 put expires on the 24th. What your target should be is what's going to give me the best bang for my buck based on my expectations for the underlying, the amount of investment I'm going to use, and the target date that I think the stock will be trading around that particular target. This tool is showing you which one would be the best to roll to going forward. Now reverse, even though we access this, we're looking at puts now, it might take a minute, but let's say our sentiment was reversed. Then the next month we actually expected maybe another 5 or 10% increase. So let's call it a 5% increase in SPY. That'd be about $14, right? So we put us at from 286 right at 300. Okay? So I'll put in 300. Now as it plugs and chugs, what do we expect to see? What it's going to show me now, again, based on my investment amount that I'm going to put into the position and the expected target date, this is going to show me the call options that would give me the best return if SPY hit 300 on, of course, our target date as well. So when I saw originally that your 225 put is now only at 3 or 4 cents of value, Eileen, and that's why to me that taking into account what you lost on that original position is important. But what's more important is to get back to break even is what do you think the underlying is going to do next? What time frame do you think the stock is going to hit at that price? And then using the option finder tool, which is always faster than it currently is showing right now during the webinar presentation, will give you the option that would give you the best bang for your buck based on your expectations going forward. That is the answer. Now to me, that's the real answer. Okay. Now here we are at the, wow, December 500 call, which yields the highest return based on the Black-Scholes pricing model of, again, almost 118%. Why isn't it showing me any, I apologize, why isn't it showing me any May options, June options? And it's because with that movement right now, because of the high price of the current options due to the increased volatility, even with this 5% move we talked about, is actually pretty small for a stock if you think about it. You're buying a call, you want something you're expecting a good 10, 12, 15% gain. But just a common 5% move, it's typically going to be a deep out of the money, far out in time option because the current implied volatilities are so high. Now, if I put this back up to 320, and again, that would be very speculative, we would start to see the June series and the July series come up closer in rather than the deep out of the money far out options, which are the only ones that would expect to see a gain with a 3, 4, 5% movement in SPY in the next 20 to 30 days. Okay? The other costs are too high, and that time value for those 30 and 40 day out calls on SPY are going to decay very rapidly. All right, so, okay, you paid $5. Okay, great. I understand that. You paid $5 for that. So again, going back to what we talked about with the bull put credit spreads, which is a completely different position, Eileen, when I'm buying a call or a put, even if it's for protection, if I'm buying VIX calls back in the day when the VIX was below 14, you know, buying a deep out of the money VIX call 45 days out in time for $1 premium, usually around the $17, $16 strike. If I lost 50% of that, so in your situation when the option dropped down to a price of $250, I would have looked to roll or adjust at that time. But now we're past that point. You've got 7 days left. Honestly, if you have the capital, instead of even considering rolling, Eileen, since this put that you have, we saw was only 3 or 4 cents right now, you're pretty much at 97, 98% loss on this position. Well, there might not be any harm just holding it for next week to the 24th expiration. Maybe if SPY does have a quick move down on Monday or Tuesday or Wednesday, a sudden unexpected move from some bad news that came out, you might see it go up to 10 cents, maybe 12 cents, maybe 15 cents with a spike in volatility as well. Hey, it's better than 3 or 4 cents to sell to close it. We've already essentially taken 100% loss on that initial position. So I'm not saying that if your target, Eileen, was 260 for the 22nd of May, and you bought that 292 put that came up, which would give you 118% return, I'm not saying that that's going to cover the $5 cost. Well, it did. It went from $14.70 to $32, which makes perfect sense. Right? The stock was at 260. We bought a 292 put. It'd be pretty much at intrinsic value at that point with only 4 or 5 days to go to expiration. But that would be an $18 increase in that option, which would cover the $5 loss you have now. That's why I'm saying it's based on the projection going forward. You want to take into account the loss you took on the initial position, but remember, what your target should be now is there a correct put to buy? Not necessarily. Is there a correct put to buy if you have a target expectation and target time frame for the underlying? The long option finder will show you which one it is. That's what I'm looking for in that approach. That's why I'm considering looking at the position new rather than focusing on the loss on the initial position right now. But we may want to get together some other time, Eileen, perhaps, and talk about a trading plan for your buying options, even if you're buying put options, to hedge the portfolio, to, as we talked about, set triggers, because we don't want to see and we don't want to realize a 60, 70, 85, 90% loss in a long call position. We want to cut those losses short beforehand or manage the position. Going back to what we were looking at, the tool with the custom spread tool, we were building the charts. We're just going to build another put option here. Let's go ahead and buy that SPY 292 put for May 29th, okay? So Octavio's question is, when doing this on the chart or when linking to the chart from the start, we'll do it both ways real quick. I'm sorry, it was May 29th, yeah. Okay, we want to look at that 292 is what was suggested by the long option finder, right about at 1450, 1470. Okay, so let's just buy one. So again, I'm sorry, Octavio's question is, where do I find the volatility, implied volatility, on the profit and loss chart screen, or can I get it to autofill? It's already autofilled, and it's right there. Okay. That's the current implied, usually it's the implied volatility. If it's a shorter term option, it might be the SIV, the Stock's Implied Volatility Index, Octavio, but it's always right there shown on that first line. Now, again, I project the stock's going to be trading at 260 on, what did I say, May 22nd, but I'm expecting maybe a volatility increase. So let me not only see what my intrinsic gain would be, but let me increase my volatility from 0.2918 to 0.35 as the market starts to fall a little bit more, okay? And there we go. We see this go up to 3203, pretty much the same as we were looking at, because that change in volatility is not too much. Of course, if I expected the stock to rise and the volatility to change, I could do that as well. So if you link from the search tool, Octavio, you link from the option chain, you open a position new in the profit and loss chart, any option that's 30 days out or more is already going to fill in the volatility for you. That's the implied volatility of your option. If it's under 30 days, if it's under 20 days, it might be using the SIV, Octavio. That's the Stock's Implied Volatility Index. It is the average implied volatility of all the in-the-money and out-of-the-money near-term calls and puts around your strike price. But after you've put in your options, we have our screen. You have the volatility below. Initially, we saw it was 0.2918. But if you want to check it and verify it very quickly, simply click the More Information button next to your options listed in the Trade Details section. Go to Research. Go to Option Research. An extra move or two, but this Option Research page shows you all of the data that we have for the option. It's loading the history of the option prices. That's why it didn't snap right in. So if I go back here, of course, and I go to Research and Stock Research, the Stock Research pops right in. The options one takes a while because it was using all of the data to show the historical prices where we're looking at option vid versus implied volatility, and you can do different comparisons here on this chart over the lifetime of the option since it was released on the market. But to your question, here we are directly. Implied volatility 0.2918, exactly what we saw when we first opened the chart. It's listed there at the bottom already. If it was the SIV number, you would see the implied volatility right here. And you see here is pretty much close to what the SIV is anyway in that case, Octavio. So that's how you'd find the volatility, but it's already shown for you once you submit a position down here at the bottom. Now, Let's keep this position, but hey, let's convert it to, this was buying a put, so let's convert it to a bear put debit spread by selling the 290. Why not? Okay, so we'll go to our May 29th expiration once more. 42 days out in time. We're going to sell to open. Oh, let's go a little wider, shall we? Let's go to the 288. We'll do a 4-point bear put debit. All right, so we're going to sell that. Bearish strategy. Lowers the cost of the call, but has a capped gain, unlike the long put. I'm sorry, I said call. All right, so there's my bear put debit. Why am I going through this? They're already in for me, Octavio. There you go. 0.2918 as we saw for the 292 put, 0.3081 for the 288. And of course, I can just change the volatility numbers here if I expect an increase or decrease in volatility to see what they would be at any time between now and the expiration date. Okay, and I'm sorry, Eileen, thank you. You're very welcome. That was a great question, Eileen. But yeah, the long option finder there, that's what we want to use it for Octavio. That's where we see the volatility. It's fantastic.